All right, guys, thanks for coming. Sorry, give me a sec. Okay, guys, thanks for coming. I hope you can hear me clearly. I'm sorry, but I'm outside, so I do have to wear a mask. Anyway, thanks everyone for making the time to be here, and welcome to our DSC workshop for Intro to Finance. Uh, Before we begin, I would like everyone to turn on the cameras so that we can have a good photo together before we embark on this workshop together. Thanks, guys. Very quick one. Just one photo, then you can turn off your cams already. Is Melvin around?
Yeah, give me a minute.
Okay, great.
Yeah, I'm done.
Okay, thanks, guys. Okay, let's move on to our workshop. So before we begin, I'd like to introduce to you guys what DSC is about. So maybe some of you guys will know what DSC is about. So a very quick introduction. DSC is a club where we try to host events to give back to the community. And so far, there has been 750 DSC chapters across the world. So, and for us, DSC and US, we're still very new and we still have a lot of potential to make a difference in the community. And since our inception, we've grown the team substantially, and we hope to continue to do so. Now, what do? We try to build a community of learning through empathy and curiosity by advocating a growth mindset, sharing knowledge, and to engage and impact community, which is why we're having such a workshop. And you'll see that we have many other events coming up that I'm sure and many of you want to be a part of because we really want to give back to the community for the betterment of the community. And so if you see this slide, these are the events that we'll be holding throughout the year. And if you want to find out any more information, these are the relevant links that you can find us on. Now, our tech team is comprised of these people, and my name is Luke, by the way, and I'm from DZA Year 3, and I hope that everyone finds this workshop enriching and take something out of this. Okay, so I'll be covering the introduction to finance in our series of finance workshops. Subsequently, after this workshop, there will be a couple more workshops, and one of them would be the algo trading workshop. So I hope that you guys can take away something from this and also look forward to the next one. Okay, so here's the content that we'll be covering throughout our time in the workshop. Financial markets, financial assets, financial analysis, risk management, and finally, financial data. Okay, so financial markets is a very broad term. It is referring to any marketplace where trading of securities occur. So you hear things like stock markets, bond markets, even the forex market. These are all marketplaces where there's active trading that is going on. And financial markets are vital to the smooth operation of capitalist economies. And yeah, as Singapore, definitely you will be exposed and even heard of markets. And I'm sure that you guys will be interested in this. Okay, so a very quick introduction to financial markets if anyone uh, still doesn't have a clear understanding of what it is. Imagine a fisherman who wishes to sell his fish but has no place to do so. And conversely, restaurants that need to stock out on fish but has no place to purchase it. Well, here is where all the markets come in. They are arenas in which buyers, sellers can gather and interact. And in general, only two parties are needed to make a trade, and a minimum third party is needed to introduce competition and bring balance to the market. So this is a very basic concept which you really need to understand, and so that you can wrap your head around what exactly we'll be talking about in the following slides. And the examples of financial markets are the stock market, bond market, forex market, derivatives, among many others. Okay, so there are two economic functions of the financial markets. Firstly is capital. Think of a company looking to raise capital to fund and expand their business. A lot of businesses, they need cost, they need to spend money on research and development, trying to expand overseas. And by offering stock shares instead of borrowing the capital needed for expansion, the company avoids incurring debt and paying interest charges on that debt. So companies can choose to incur some debt, or they can uh, issue stock through the stock market. And the second economic function of the financial market is as an investment income for those who purchase stock. It is an opportunity to share and reap the profits of the company. And in order to entice people, some stocks also pay regular dividends in order to uh, attract more investors and retain their investors as well. Yeah, so investors can benefit through dividends firstly, and secondly is through buying through the trading of stock basically, uh, in which they buy stocks and then sell stocks on the market. So yeah, that's essentially what the financial market is. Okay, the next section will be talking about financial assets. An asset is any possession that has value in exchange. So the very traditional assets that people uh, consider as financial assets are stocks, fixed incomes or bonds. They're the same thing. Real estate, forex, and including cryptocurrency now. And you might have also heard of this term called derivatives, which is actually a math in which it's just a function of the traditional financial assets. So we'll be going through something called stock options later on, and that is considered one of the more common derivatives. So financial assets are claims on real assets. It is a combination of these financial assets that one will be able to make up a portfolio at the desired risk. So everyone has a different type of risk appetite. You might be risk seeking. So for example, a lot of young people, they want to try their hand at the stock market, for instance, and they will be considered risk seeking. People who are risk averse perhaps maybe want to invest more in fixed income. Yeah, so different people at different age groups form different clusters in which they have different risks, and we'll be going through that later on as well. And just a reminder, risk is often measured using volatility, which is the standard deviation of the asset returns. There are other ways to calculate risk, but the most basic that I hope everyone understands is volatility. When a price goes up and down, there's a lot of risk involved. You don't know which way the risk, the the value of your asset might swing. So risk, volatility is a very important metric for risk. Okay, so we'll be going through each of the different assets briefly, but I want to focus more on the stocks. So if you see on the slide here, uh, the picture on the right side is something that you will see on Yahoo Finance. And if you cannot figure out what this is about, I will try to explain to you what's going on here. So at the top here is of course the company, and maybe sometimes they also list out the exchange that they are being traded on. And then this number 2507, that is the current price. And you can see that there's numbers here also. The percentage shows the change from the previous day, and the number 0.02, that is the actual change from the previous day. So of course, if it's a negative 0.02, then the color will be red, indicating that the stock is trading at a lower price. Okay, so that's number one. Number two is the data that is called open, high, low, close. So open, high, low, close is different prices at different uh, periods in a day, because stocks are being traded intraday, which means to say that throughout the business hours, the price of the stock may go up and go down. So the opening price is, in this case, 24.8, and the highest throughout the day, 25.07, lowest 24.72, and close 25.07. And oftentimes you'll see another column called adjusted close. Adjusted close is the last transaction after adjustment of dividend and split. But you should also know that there may be many errors that often occur, especially when the time horizon is long. So, okay, and the final thing is volume. Volume just indicates the number of securities that is being traded in a period. So, looking at this table, you can see that for the days from 17 December to 23rd December, you can observe their open, high, low, close, including adjusted close and their volume. And this is the most basic information that people want to see. There are many other things that investors, traders want to also look at, and those things will be part of financial analysis, which will be briefly touching upon later on. Okay, so what can you do with the open, high, low, close data? If you observe this chart over here, you can see that there's a very weird looking graph. Basically, how you read this is, if the color is red, it means that from the previous day, the stock price has dropped. And if it's green, it means that from the previous day, the stock price has gone up. And if you zoom in even closer, uh, you can observe the open, high, low, close. I don't know if you can see it, but for a single line on the left, you can see like a small little line that will be the open, and on the right of a line, that is the close. And the length of each day, the length for each day, that is considered the min max, which is the highest and lowest throughout the day. Okay, so this is what I just said, and yeah, there's a lot of things that you can take out of this chart. It is very useful because it can show important things like momentum, which is what investors want to look at. When the open and close are far apart, it also shows strong momentum. And when the open and close are close together, it shows indecision or weak momentum. The high and low shows the full price range of the period, and it often indicates volatility throughout the day. Okay, so I shall move on. The next financial asset is bonds. Bonds is a security that is issued in connection with a borrowing agreement. The issuer agrees to pay the buyer specified payments on specified dates. Corporate bonds, which are issued by firms, and government bonds, which is issued by governments, are very common type of bonds. There are many other types of bonds, but corporate bonds and government bonds are the most common, and bonds represent the debt of the issuers. So when I explained just now that a company can incur debt or can issue stock, that's how they gain uh, capital for them to embark on their R&D development. So they can either issue stock or they can issue bonds for people to fulfill in order to raise that necessary capital. So bonds in general are generally less risky than stocks because bonds carry the promise of the issuer to return the face value of the security to the holder at maturity, whereas stocks have no such promise from the issuer. The stock might just go up or go down, and it is to the it might be detrimental to the person buying the stock if the stock goes down in price. Okay, so most bonds pay investors a fixed rate of interest income that is also backed by a promise from the issuer. If you didn't know, if a company goes bankrupt, they are obligated to address the bonds first before the stocks. So that is also why bonds are considered less risky than stocks. And that is something that you might want to take note of. Stocks, sorry, stocks sometimes also pay dividends, but it's up to the company. A company may or may not pay dividends, but the issuer has no obligation to make these payments to the shareholders. Now, historically, the bond market has been less vulnerable to price swings or volatility than the stock market. Okay, so the next slide. Okay, this one is about real estate. I won't go too deep into this because uh, I don't really have much experience in this as well, but I want to give you guys an introduction to it. Real estate is basically rent. How much rent you can charge depends on where the rental is located. It can be difficult to determine the best rent because if you charge too much, you chase tenants away, and if you charge too little, you leave money on the table. As the landlord, you'll be responsible for things like paying mortgage, property tax, and insurance, maintaining the property. So all these things you will have to take charge of. However, there's a lot of benefits to real estates because generally it tends to appreciate over time, but there's no guarantee. Uh, if your property appreciates in value, you may be able to sell it at a profit. However, it is very illiquid due to its predominantly private nature. You don't see people trading real estate on any exchange because of the nature of real estate. It is simply too illiquid to be doing trading houses on the exchange. Also, there's a prolonged length of time and amount of effort usually needed to complete the transactions. There's a lot of contracts that need to be signed, and all these things add to the illiquidity of real estate. Okay, so while we were talking about illiquidity, another asset that is very liquid is the forex market. The forex market is where you do your currency conversions, but people also do it in order to do their trading and earn a profit from that. So it is a global marketplace for exchanging national currencies against one another, and is the most liquid asset market in the world. And that's why if you do any trading, if you sell or buy any uh, forex related assets, the buy and sell margin is very thin. So you can expect to have good prices simply due to the volume that is traded and the liquidity of the asset. So currencies trade against each other as exchange rate pairs, for example, a euro to US dollar. Uh, and the amount of currency converted every day can make the price movements of some currencies extremely volatile. It is this volatility that can make Forex so attractive to traders, bringing a greater chance of high profits while also increasing the risk. So I'm sure you guys have heard of the term high risk, uh, high return. This is one such example. If you're a person who is very hungry for risk, perhaps you can consider the Forex market. Okay, so I will be moving on to the financial analysis portion. For this portion, I will also do a bit of touch and go because the subsequent workshop will cover more of this. So financial analysis involves using financial data to assess a company's performance for decision making. This can be internal or external. And there are two main types of financial analysis. Firstly, fundamental analysis. Secondly, technical analysis. So fundamental analysis involves using the ratios and analyzing financial statements to determine the intrinsic value of a security. Using ratio analysis in addition to a thorough review of economic, financial situations surrounding the company, the analyst is able to arrive at an intrinsic value for the security. So generally, people do fundamental analysis by going through the annual reports of companies that they might be interested in. Another way is to read a lot of market analyst reports that can be like a subscription base, or you can even find some on the internet for free. But anyways, these are the things that people look at in order to do fundamental analysis on different companies. And the end goal is to arrive at a number that an investor can compare with a security's current price in order to see whether the security is undervalued or overvalued. The next one is technical analysis. This one assumes that a security's value is already determined by its price, and it focuses instead on trends in value over time. Uh, so in the next workshop, we'll be going through things like the RSI and Bollinger Bands. These are things that is part of technical analysis, which involves simply just looking at a security's volume and price while ignoring the fundamental analysis. Of course, you can blend both fundamental analysis and technical analysis into your investments and trading. But if you're simply doing technical analysis, you'll be only looking at the price and volume. Okay, so technical analysis attempts to understand the market sentiment behind price trends by looking for patterns and trends rather than analyzing a security fundamental attributes. Right, okay. So before I move on, do any of you guys have any questions? I will take a break. Sorry, I will take a moment, see whether there's any questions. Feel free to ask anything. If you're lost or like you want me to clarify on something, just shoot. Nothing? Okay. Okay. All right, then I shall move on. Okay, the next section is quite interesting. It is about risk management. So risk management is about attempting to identify and then manage threats that could severely impact your financial portfolio. So let's say you bought some stocks, but you don't know how to manage the risk that is associated with it. Stocks are pretty risky assets to be having, so there must be some sort of like risk management to help cut down losses, and it can also help to protect a trader's account from losing all of his or her money, because really the risk is there, and want to you want to try and move the risk somewhere else. And if it can be managed, uh, then the trader can open him or herself up to making more money in the market. So we'll be introducing two strategies to manage these risks. Firstly is diversification. Second one is hedging through options. So diversification is a technique that reduces risk by allocating investments across various financial instruments, industries, and other categories. It aims to maximize returns by investing in different areas that would each react differently to the same event. And through diversification, you avoid putting all your eggs in one basket. Say, for example, your portfolio is made up of just one company stock. Imagine what will happen if the next day the price of the asset goes down. That would mean that your entire portfolio is suffering a loss. And I'm sure many of you can understand what diversification is. It is just to avoid all the risk that can come from focusing on just one asset. Okay, so for this diversification, there are two main risks that investors have to consider. The first one is firm-specific risk, which is also known as unsystematic risk. Risk related to the individual firm's stock return, such as business risk and financial risk. For example, Apple stock, if it crashes, that is called a firm-specific risk. And the other type of risk is called market-specific risk, systematic risk. This risk is common to the whole stock market, such as recession, inflation, high interest rates. So if the whole market crashes, if Apple crashes tomorrow, if Microsoft crashes tomorrow due to the same event, that is a market-specific risk. Therefore, a stock held in isolation has these two sources of risk. Okay, so unsystematic risk can be mitigated through diversification, while systematic or market risk is generally unavoidable. As the number of securities held in a portfolio increases, the risk of the portfolio decreases to the market risk. I won't go too deep into the math, but you just have to understand that the more securities you have, you can actually lower the risk to the point where you totally eliminate the systematic risk, as long as the securities do not always change in the exact same direction. Okay, so I'll present to you two equations. The first one is your returns for the portfolio, right? So if you look at this equation, you have two stocks, D stock and also E stock. What you have here at the bottom, ERP, that means expected return of portfolio. That is simply the weighted returns of your individual stocks. And that is your expected return of portfolio. The second equation is the volatility of your portfolio. And this is calculated through the equation as shown. Okay, so if you move on to the next slide, when I was talking about stocks D and E, you can visualize it on this graph as shown. Stock D over here has a standard deviation of 12% and also expected return of 8%. And on the other hand, stock E has a standard deviation of 20% and expected return of 13%. So just by glancing at this graph, you can see that stock E has a higher risk than stock D. Now you want to be able to diversify all that risk, and you want to find a company where it is very uncorrelated with each other. Imagine if you only have two stocks in your portfolio and their correlation coefficient is 1, it means that your risk is just this. And any combination of D and E will be found on this line. Hope you guys can see here, right? So as you inch closer to correlation coefficient of -1, your line starts to curve and your line will eventually touch the y-axis. So at the y-axis, you can see that your standard deviation is actually 0%. So that is how diversification works. And you can expand this concept to more assets in your portfolio. This is just an example for two stocks. And from this explanation, I can tell you that you can actually reduce your risk to 0. But in reality, it is very difficult because how are you going to find two companies that have a correlation coefficient of -1? It is close to impossible because it's very difficult for two stocks to be following each other negatively through a certain period of time. And that's just not very realistic. But this is the best case scenario in which the correlation coefficient is -1. Okay, so once you are able to understand that concept, you can expand this to multiple things. So imagine you have all these different assets that you can invest in and you know there are expected returns and volatility. So cash is here. It has pretty low returns, low standard deviation. You look at another thing, commodities, 20% standard deviation and around 8% return. So all these individual dots that you see, these are different assets, and you can plot out their risk and return when you invest in them individually. Now, when you start to plot out, as what I showed here just now, you can see that there's a line that uh, essentially covers all of them. This is called the efficient portfolio frontier. If you want to know more about it, you can go read up about it. Uh, Essentially, it just says that the efficient portfolio, given a fixed level of risk, the expected return is the highest. So let's say that your risk appetite is pretty low, like hovering around 5%, then your return will be around 6%. And conversely, if your risk appetite is 20%, then 14% will be your return. And this is how diversification works. Now, what are the drawbacks of diversification? Uh, Firstly, of course, it is very cumbersome to be managing so many stocks. Secondly, it's also the transaction fees from broker fees that could end up limiting your returns. Right. Okay, so I will introduce to you another method to do risk management, which is called options. And this section might be quite dry, but it is a very important concept for the stock market, especially. And I hope to be able to relay this information to you guys. So, hedging is a strategy that tries to limit risk in financial assets. Popular hedging techniques involve taking offsetting positions in derivatives that correspond to an existing position. So specifically, we will take a look at hedging stocks using stock options. A stock option is a contract that gives its holder the right but not the obligation to buy or sell the underlying stock at some predetermined price prior to the expiry of the option. Now, you have to take note that the owner does not have to exercise the option to buy or sell the stock. It merely gives the owner the right to buy or sell an asset. Okay, so there are two types of options. The first option is a call option. A call option gives the holder the right to buy a stock. The holder has a bullish outlook for the price of the underlying asset. So bullish means that the investor expects that the stock price go upwards and they will profit if the underlying stock price rises prior to the option's expiry. And on the other hand, put options. Put options give the holder the right to sell a stock. The holder has a bearish outlook for the price of the underlying asset. So the holder expects that the price of a particular stock drops, and hence they will be able to profit if the underlying stock price falls prior to the option's expiry. So just a note on the strike price. It is also known as exercise price, and it is a price at which the delivery occurs. Okay, so here's a concrete example. For example, owner of an Apple call option gives the holder the right to buy 100 shares of $70 per share on 1st of Jan 2021, when today's price is 122.28. So the $122 is actually before 1st of January. And this call option gives the holder of the contract to buy 100 shares of 100 at $70 per share on 1st January. Now, in this case, $70 is the strike price. If the price of Apple stock is $74 on 1st of Jan, the owner profits because he is able to exercise his option at each Apple stock for $70, which is worth $74 on the market. His payoff is hence $4 per share. Okay, so here are some mathematics that options has. Mathematically, for call options, the payoff at expiration is max of stock price minus strike price, comma 0. So it is a higher of the two. Okay, so another example, on the expiration date, a Dell's call option for one share with an exercise price of $30 has the following market values at these prices. So as you can see that while your stock price increases in value, your call option increases in value. And specifically at $30, that is when your call options value becomes valuable because you'll be able to exercise your price of $30 while the stock's price is actually more than $30. So you can see that there's a gradual increase of the call options value after a certain price, and that certain price is the exercise price. And that is visualized through this graph. The $30 here indicates the strike price. After this point, when your stock increases in price, that is when the value of your option increases. Now, on the other hand, the mathematics for the put option is as such. The payoff at expiration is max of the strike price minus stock price, comma 0. So it's a max of the two. Okay, so if you recall, put option is the ability for you to sell an option at a pre-specified exercise price. And in this case, it is $25. Okay, so so let's say your stock price is $15 and it gradually decreases to $40. Your put option will head towards $0 once it crosses the $25 mark because it is not valuable to be using that option contract. Now, this is the graph of what I was talking about. You can see that once the stock price increases beyond your strike price, the value of your option becomes 0. Okay, so as a note, options come with a fee as well. To be an owner of an option, you have to incur a premium or a fee. So in practice, there are many strategies that people use in order to hedge the risk involving different combinations. Okay, so the simplest strategy is as follows. Sarah buys stock at $14 per share. Sarah assumes that the price will go up, but there is risk in the event that the stock value plummets. So that's a very real situation that people might face. You buy a stock, but then you're afraid that the price might drop. So there's that risk. So what does she do? Sarah pays a premium to buy a put option. With this, she can be given the right to sell the stock at $10 within a 1-year time frame. If in the 6 months the value of the stock she purchased has increased to $16, Sarah will not exercise her put option and will have lost $7. However, if in the 6 months the value of the stock decreases to $8, Sarah can then sell the stock she bought at $14 per share for $10 per share. So with the put option, you can see that Sarah has limited her losses to $4 per share. Without the put option, Sarah would have lost $6 per share. And if you expand this to even greater magnitudes of numbers, you can see how this is a very useful strategy to have. And by the way, this is known as a protective put strategy. There are many different strategies that one can take in order to cover different types of risks. And if you understand the concepts of call options and put options, you will be able to form up your own strategy in order to cover your risk. So here are the drawbacks of hedging through options. The first thing is that hedging involves premiums, which can really eat up your profits. So there's no free lunch in buying options. You definitely will need to buy premiums. And another thing is that options can be complex to fully grasp. What I went through just now was a very brief overview of what options is about. If you can really understand the options, you can really leverage that as your strategy. Okay, so now I will take a break. So if you guys have any questions, please say in the chat box. Let's come back at 8:55, so around 10 minutes of break. Yeah, so in the meanwhile, if you guys have any questions, you can ask away or you can ask in the chat. So someone has asked about what sort of Python libraries are used in technical analysis besides like the mathematics or statistics one. Okay, generally for technical analysis, I would say that pandas and NumPy are the most critical ones. If you want to go and code it out by yourself, honestly, it's a very difficult thing, but I'm sure it's possible. And I think that pandas and NumPy and those two libraries will be sufficient enough. But just take note that there are a lot of tools out there that do technical analysis already for you. So if you want to go and implement your own technical indicators, I'm assuming for trading, there are tools already. So I mean, if you're curious about it, you can go and Google about how to create values for your Bollinger Bands, for example, and that can be done using pandas. And if and yeah, I wouldn't recommend anyone to go and calculate the technical analysis by themselves because there are a lot of tools out there already. But if you want to have a jab at it, definitely pandas and NumPy will help you in that because of how flexible they are and because they cover most of the mathematical functions already. So someone asked about brokerage fees. Is it still feasible for retail investors to carry out algo trading? Okay, so on the point of algo trading, personally, I haven't done much algo trading, but maybe Jared would like to chip in on this. It's really up to your own risk appetite. I mean, for starters, will you want to be using an algo trading for your own hard-earned money? I'm sure most people would start out by getting their hands dirty using brokers. And any good broker rich to recommend, I would recommend Tiger Brokers or Interactive Brokers. Either of them is fine. I'm assuming for stocks, if it's just stocks. Wait, will you guys teach? Will you? So someone asked, will you guys teach Python for systems trading? Um, so in the next workshop, we will go through a bit of algo trading, and that will involve some Python. So stay tuned for that. Someone asked about GME. Yeah, GME is quite crazy now. So if you guys didn't know, GME went up like 100% intraday yesterday. So if you want to get in on the hype, you can do so, but know of the risks. Understand your risks, set limits to your risks. And most importantly is research. If you're coming into this, if you're coming to this workshop as a beginner and you want to do GME trading tomorrow, I think I would really advise against that. You really need to do research about what are the tools, uh, what to look out for in stocks. All right, so there's another question about good resources, websites to use to do research, especially for beginners. So if you scroll down to the third last slide, you can see a slide on different resources that you can start on. I find Investopedia like the number one place to go for terms that you will come across very often. So if you're going to start trading, for example, things like market order, limit order, stop order, these are things that you can find on Investopedia. YouTube is another source. Seedly, CFI, these are all reputable and reliable sources. And of course, if you want to learn it in school, you can also try your hand out at Fin 2704. Yeah, so there's a advertisement. All right, guys. Hope you guys had a good rest. We'll finish up in about, I'd say, 20 or so minutes. And I've already sent the link to the Python notebook. Hope that you guys have already downloaded it. Yeah, so before that, before the Python notebook, I will want to introduce to you three different calculations that's the most basic to calculating your risk and returns. So financial data, we'll be using some financial data, uh, and once we attain that financial data, we need to do some calculations in order to get different metrics. So the first one is expected returns. For expected returns, we want to assume that daily return is independent and identically distributed, random variable drawn from the same distribution. So what this essentially means is that your expected returns is an average of your historical returns. There are many ways to calculate expected returns, but the most basic way is to do an average of your historical returns. So expected returns is not your actual return. It is the return that you predict will be the next return uh, based on historical data. Okay, so if you don't understand this equation, it is simply an average of your historical return. Okay, so and the next one is expected risk. In expected risk, you assume daily return is an independent and identically distributed random variable drawn from the same distribution. So, expected risk is simply taking your returns. Take note is return, not price. Take your returns and do a standard deviation calculation on that. And that is how you get your uh, volatility metric. And the next natural step after that is the Sharpe ratio. The Sharpe ratio is a measure of return uh, often used to compare the performance of an investment managers by making adjustment for risk. So when analyzing returns, it is not enough to be just looking at returns. You need to be able to compare against the risk that you took in order to gain that return. So the Sharpe ratio is the metric that is used to calculate your return, adjusting for risk. And as you can see, the Sharpe ratio is simply the return of your portfolio minus the risk-free rate over the standard deviation of your portfolio's excess return. Okay, so from here on, I will be looking at the Python notebook. If you guys don't know how to load it up, I will show you. So you go to Google Colab. Now from here, you want to upload the document that is named that is in the Google Drive. It ends with an IPYNB, so you simply choose that file. Yeah, so it's named Financial Analytics IPY Notebook, and then you just open it.
I cannot see your collab screen.
Oh, sorry. Wait. Can you guys see now?
Yeah, that's slides.
Okay, then my notebook. Okay, I shall restart.
Yeah, can.
Okay, so after you downloaded that file from the drive, go to Google Colab. From Google Colab, you upload. So you choose the file ending with IPYNB. So just click Financial Analytics IPYNB, and then you click Open. Yep. So this will be the notebook that we will be working on. We'll be doing some of the calculations that I was referring to just now, and introducing to you different libraries that will be very relevant to analyzing your market data. Okay, so if you guys don't know how to use the notebook, when you click the play button for each cell, it will simply run that cell. So for example, if I click this one, it will run this cell that is being selected. Okay, so that has ran. I'll briefly run through the code. The first thing you want to do is to import NumPy and pandas. And then the second thing is importing date time, which will be important for calculating our returns afterwards. The third one is matplotlite, which is a graphing library. Found tools that will be used in a certain function later on. And finally, for pooling of data, we will take it from pandas data reader.data, and you import the data reader class. Okay, so once you have run that, it means that all your libraries that are specified here are already loaded up. Okay, so we want to test whether that was successful or not. And I start off by clicking the run button here. Okay, then I run the next one. So, okay, yeah, so you can see that it starts from 2014 December. And then if you want to plot it out, actually, I'll show you the entire data set also. Okay, so the data set, it ends 1st January 25th, meaning it takes data from yesterday. So this row, this is yesterday's prices, open, high, low, close. Okay, then the reason why it extracted as such is because I specified the ending date as today's date. So when you extract the data, you want to specify the ticker name. So this can be Google or can be Netflix, whatever. The second one should be Yahoo, because we're extracting from Yahoo. The next parameter is start. Start is when you want to start the date at which you want the open, high, low, close data to start from. The last one is date, the end date. And this can be anything. This can be 2014, sorry, not 2015 January, for example. Yeah, so that one is flexible. But for this demonstration, I've done date time today, which makes us end off at yesterday's closing price. Okay, so a very simple start that you can do is to do a plot. So if you do a plot, you'll get something like this. But as you can see, it's not very useful. You want to be able to observe the high, low, open, close, and also the adjusted close. And that can be done through this plotting library. You can import this, import plotly.graphObjects as go. This one, once you reference this, you'll be able to plot out a candlestick graph as what I was showing just now, whereby you'll be able to see the open, high, and then also the low close of each day. So when you run this, you'll be able to see a candlestick graph. And in this plotly library that I imported, you can actually also adjust the range. So you can actually observe for a certain time period the open, high, low, close, and even hover. So it's quite interactive. This library is pretty good in identifying for a certain date the open, high, low, close in a visual manner, and also using metrics. Okay, so there's that. Okay, so once you have the price, you will want to also calculate returns. Returns has to be calculated using adjusted close or close, depending on your preference. So if I run this, I will get a series of the adjusted close from the data that I just extracted. So Apple's data, I zoom in just on the adjusted close column. That is what I am doing at this line. Okay, so I test out my series and check whether my adjusted close 142.9 matches up with this. Yeah, so as you can see that the adjusted close column is what I just extracted into the series variable. Any problems? Am I going too fast? Sorry, let me check the chat. Okay, seems like everyone's doing fine. I hope everyone's following along. The next thing is to calculate the previous close. Because return is calculated using the current day's price and also the previous day price. And in that, we have to calculate the previous close. And as you can see, what I'm doing here in this cell, I am assigning a previous close column to my series data frame using the previous day's price. So visually, that would be what you see here. You can observe that for 2015, 5th of January, your adjusted close for that day is 24.197, and your previous close exactly matches the previous day's adjusted close. And that is your previous close column. Now, your percentage return is simply your adjusted close minus the previous close over the previous close. So it's simply a percentage change. Okay, so, and that's what I'm doing here. When I do a drop NA, it just means that I'm dropping the row that was 2014, because 2014 actually shows NA, and that's why I dropped the NA. Small step, but just a reminder. All right, so using this function, you can scale this up. So what do I mean? I can run this, and using specified tickers, Apple, Amazon, Facebook, Google, Netflix, Microsoft. Okay, once I specify that and run it through the function is called get data for multiple stocks. Yeah, so using that function, I can run these stickers through that function and arrive at a stock dictionary which contains all my tickers data. Now, I want to compile everything into a single data frame, and that is what I do here in this step. So this step essentially just joins all the different data frames together in order to create this final data frame. So very nicely, you can see that for a certain date, you can see the percentage return for different companies. And yeah, you can do that over time. So you can see how we can use this in our analysis. Now, the reason why people look at returns is because price is all relative. You have to look at returns for you to check whether a company is profitable or not. And a way to calculate whether the returns are good or not is using cumulative product, which is essentially just accumulating your returns over time. And that is what I'm doing here. From 2014 to the current day, you can see the trend of cumulative returns over time. And as you can see, tech stocks are doing pretty well. And of course, you can change the tickers and compare against different sectors as well, different companies from different sectors, and compare their cumulative returns. Okay, the next one I want to get into is the volatility. Volatility is, as you remember, is the standard deviation of your returns. So, actually, I think I missed out a comment here, but you can see I did some calculations here whereby I multiplied by the square root of 260. So actually 260 is the number of trading days in a year. When you do a DF-STD, you're just getting the volatility using daily returns. But if you want to get that in an annualized volatility plot, you will need to do a square root, a multiplication of square root 260. And that is what I'm plotting right in this plot here. So just from this graph, you can see that Netflix is the most volatile, is the most risky stock to be invested in from the time of 2015 to current. Okay, so that is volatility. The next one is the Sharpe ratio plot. This one, as what you saw in the volatility calculations, it also uses the 260. So just a reminder, 260 is the number of trading days per year. So my calculation here, you can see is the mean of my returns. So mean is also what I'm using as expected returns. So recall, Sharpe ratio is returns over standard deviation. And that is exactly what I'm doing here. DF mean over standard deviation multiplied by square root 260. Okay, so let's say you want to do monthly volatility, then you have to multiply by square root of 12 because of the 12 months. And yeah, so that's why I'm multiplying by square root of 260 because I want to get an annualized Sharpe ratio. Okay, so that is my Sharpe ratio plot. And generally, if your Sharpe ratio is close to 3, that is considered a pretty good investment and quite rare to find. And the lower your Sharpe ratio is, the worse your returns are compared to risk. Okay, so that is the end of the notebook presentation. Let me see. Okay, so someone asked about why is there a plus 0.01? Oh yes, so the plus 0.01, this step is essentially just your annotation step whereby I'm labeling the bar graphs. And the 0.01 is there in order to make sure that it's just a formatting calculation. Where if you instead just do p dot get height, it will look very weird on the graph because the number like 0.94 will be exactly on the bar graph. So so the 0.01 is simply a formatting. Yeah. Yeah, so someone asked about log returns as well. Yeah, for sure you can use log returns, in your calculations, because once you have the price, you can get your percentage returns and also your log returns. So if log returns is something that you want to do, you can very easily do it in the calculations. But I'm off the top of my head, I don't recall the log returns calculations. Are there any other questions? Any questions? Any questions? Okay. Can publicly share this to my Google Drive. So the way that IPYNB works is that you can run it on Google Colab. So you just have to download this file from the Google Drive that we just shared, load it into your computer. Then from Google Colab, you just load up that file. And I'm not sure what you mean by publicly share this to my Google Drive. I mean, you can use that file to your own liking. You can just upload that anywhere. Yeah, is your file. Okay. Okay, I'll also open up a pigeonhole so that if you have any questions for this session, you can ask me. So yeah, guys, if you have any questions, you can use this link. You can scan the QR code. Okay, yeah, I'll just wait a few more seconds if no one has any questions. Okay, so hi, besides stock price, is there any way to pull quarterly earnings data to do earnings report analysis? That one I'm not too sure, but given how open like libraries are nowadays, I'm sure you can find something that will be able to pull quarterly earnings. Yeah, and earnings report, by the way, is actually fundamental analysis. So not very familiar with that. Yeah, but if you can search up any libraries that will be able to pull this sort of data, yeah, that would be the way to go. And as you saw from the way I extracted so easily the Yahoo Finance data, is a very simple way to pull data from anywhere. Any other questions? All right, I'll give another 10 seconds. Anything about the whole session? Any comments or? All right, okay. Okay, so with that, I've come to the end of my presentation. So what we have gone through forms the very basic foundations of finance. And I really hope that everyone here has learned something new. If you're new to finance, definitely continue that passion and continue to learn through resources such as Investopedia, YouTube, Seedly. The internet is yours for you to explore. So you can just research as much as you want. Don't jump into investing without any knowledge. about the risk that is involved without any knowledge about metrics that are important. Yeah, so before using any real money, perhaps you can also do paper trading. Paper trading is a way for you to test the market, see whether your strategy makes sense before you actually put in money. So from what I know, interactive brokers, if you want to do stocks, is a way for you to do paper trading, to test your trading strategy before you use any real money. Yeah, so just a disclaimer, if anyone wants to continue to learn in school, is definitely a good way to learn, because I mean, you're in school after all. So if you can learn finance, that would be great. And just take note that there's a prerequisite for accounting before you take 2704. All right, so here are the links for our channels that you can contact us in. And if you have any questions about today's workshop, you can also feel free to email us at this link. And before I end off, can I please ask everyone to turn on their cameras again so that we can have a closing off photo? Yeah, a very quick one so that we can end off the night in a positive note. Thanks, guys. Very fast, very fast.
Okay, thank you.
All right. Thanks, guys. Hope you guys have learned something, and stay tuned for further workshops in the coming weeks.